Welcome everyone to another financial analysis session. I'm Moeed Amin with my colleague here, Ted Wainman. Ted is looking positively relaxed in his time in Cornwall, it looks like. So we should have a great session today. Today we're going to be looking at Palantir, so a company that's been in the public eye for quite a while, and an interesting business because they are involved in providing software and products that help large institutions, right? So both public and private businesses basically make sense of their data so that they're able to make better decisions, right? And so it's an interesting business for us to look at. And thank you to a couple of our viewers who have asked or requested for us to look at this company. So here is your video. Now, just a brief intro into some things that you should look at in the background, because today we're just going to look, as always, we're just going to look at the fundamental financial analysis. So it's really a snapshot of what's going on right now in the company, but we urge and encourage you to look at all the other elements of the business in order for you to make an informed decision, whether you are thinking about investing in this company or if you're thinking about doing business with them. There are a whole host of other things you should be looking at. We're not going to cover that today, but a couple of interesting things to note. So this company has two main products, the Foundry software program, and but its bread and butter is the Gotham software platform. Now, the reason why I mention that is because that Gotham software platform is really for public clients, so governmental bodies, local governments, and about 56% of their revenue comes from the US government. And that's interesting for you, both as a potential supplier or an investor, because that tells you a little bit about its customer concentration, which might be a risk factor to look into. And the second thing to talk about is the share price, which we'll cover in more detail later on. Debuted, and I think in October of 2020 at around $10 per share. It's now at about 22. So if you'd invested back then, you would have doubled your money, but it has gone through a bit of fluctuation during that time. So worth noting that it's an interesting move in the stock price, and we'll cover that in a bit more detail later on. So Ted, let's share with everyone what we found about this company and its finances. It's going to be an interesting one to look at, I have to say.
Well, good to see you again, Moeed. And as you said, yes, greetings from, I'm now on holiday in Cornwall, and it is, well, it was glorious weather. It's now very, very windy, and I'm looking forward to a bit of kite surfing later on this afternoon. However, let's go straight into the accounts. So we will find the accounts for Palantir. They're online, easily accessible, and the income statement starts on page 112. So you've got to scroll through quite a few pages of corporate governance, etc., to get down to the main numbers that we are interested in. And as we always mention, Moeed, you've already mentioned, and I'll reiterate it, we are just doing the fundamental analysis of the numbers only. You've mentioned a couple of things about the contracts and the sources of revenue, but anybody doing their own value-based investment analysis needs to kind of, do their own homework as well. This is merely part of it. So what you can see in front of you is, now also I just mentioned that we're looking at the 2020 annual accounts. The latest quarterly update is now available. And you can get those on their website as well, but we're just looking at the financials, the actual the audited annual report. And what we see here standing out is a big growth story. So if we look at the top line, the revenue or the sales, the turnover, significant increase. So just from 2019 to 2020, we see a 47% increase. And I can tell you that if you look at their quarterly statement, revenue continues to increase, and if we take their Q1 financial statement and project that out, for the full 2021. They're looking at another 25% increase in revenue. So this company is growing, and it is growing pretty rapidly. The cost of revenue is actually relatively low, leaving them with a very, very healthy gross margin. Okay, and this gross margin, they're operating at around about 67, 68%. They've managed to increase that to 78% in Q1. So looking pretty good from the gross margin. However, they are spending a lot of money. Okay, and these numbers here, the sales and marketing alone are $683 million. Okay, that's a huge amount. Plus another $560 million on R&D. Now, R&D is good because that says that they're investing for the future, but they are spending a lot of money. And we can see how these numbers have been increasing over the years. So they're increasing and increasing. And down the bottom, we have the SG&A. So this bottom number here, this is really looking at the cost of running the business. So if you look at the fundamental cost of running the business, and let me just clear those drawing. So if we take the gross profit and look at the cost of running the underlying business, it's just about profitable. As soon as you bring in sales and marketing, it's no longer profitable. And with R&D, it's actually making a fairly sizable loss. And there is the loss, 1.1, what's that? 1.1 trillion, billion dollars. Okay, so they're making a significant loss. We notice that there's a big increase in the interest, and the big increase in the interest suggests that there's a big increase in debt. So we'll look for that a little bit later on. But the ultimate story is that this company is bottom line negative to the tune of $1.16 billion. Okay, so $500 million in 2018, $500 million in 2019, and now over $1 billion loss. So this is this is clearly a company in a growth stage, and their aim is to grow rapidly, and to see if they can kind of we use this this sort of metaphorical, they can escape the gravity of this loss, they can hit their critical mass. The question, I guess, is what is their critical mass? What does this number up here need to be in order for this number here to be positive? That's really the big question. So there's our income statement. Go into our balance sheet. So here's the balance sheet. And we see, well, really what stands out for me on the balance sheet is this top line here, lots of cash. So this company, it is making a loss, but it does have a lot of cash. And you'll notice from 2019 to 2020, the cash has gone from $1 billion to $2 billion. And that's going to be due to fundraising, okay? Because if it's making a loss, it will have been due to fundraising. Nothing else really jumping out at us in the asset section. If we look in the liabilities, let me just clear those and we'll scroll that down. So if we look in the liabilities, what we do notice, in fact, we'll just move it down a little bit further. There we go. So what we do notice is, so we've got the debt. So there's the debt. Now, quite interesting that the debt is about 200 million, down from 400 million. And there's no kind of debt sitting in the current liabilities. And also we've got this is a kind of a hybrid. So they haven't classified it as part of their liabilities, but they also haven't classified it in their equity. So we should probably be looking at this is redeemable convertible stock. And ultimately what happens is that got converted during the year, and it appears in effectively that 6488 number. So that was a convertible stock which has been converted into pure equity. So what we end up with is a company. So it's quite interesting that it kind of, this is a bit that I was sort of struggling with slightly, is that the interest has increased significantly. The interest they're paying has gone from 3 million to $14 million, and yet their debt seems to be going down. So I'm not sure exactly what is going on there. It didn't quite work out for me. So lots of cash. Let's go and look at the cash flow statement and see how quickly they are burning. So here is their cash flow statement, and we see up at the top that so there's our loss in the year, 1.1 or 1.16 billion, and here is the cash loss. So they are burning cash, but they are not burning as much as they're not burning as much as their loss. And the main reason is this stock-based compensation, and the stock-based compensation is effectively a lot of the costs that they are incurring are their staff, and they are paying staff in shares. So they have a lot of people who are very, very clearly hooked in to the future success of this business. So there's a lot of people who are eating bread, drinking water, living hand to mouth, but they have stocks which potentially could become very, very valuable, or potentially could go to zero. So there is the risk. And so they're probably being very well compensated in order to compensate them for that risk. So we notice cash burn, 39 million, 165 million, 296 million. So if you remember, they've got 2 billion in the bank. They're burning at 300 million a year. That kind of gives us an idea of how long they can keep going for before it all starts to get a little bit close to the wire. So from a liquidity point of view, not a problem. These guys are going to be around for a while. A little bit of investment going on, property, plant and equipment. That's these numbers here. So they're investing in the future of the business. That's absolutely fine. And then we see down the bottom, we see the actual effects of the funding. So here's almost $1 billion they raised by issuing new shares. And don't forget, every time they issue shares, they dilute existing shareholders. So that's something to be aware of. They've got repayments of borrowings and issuing of debt. So they issued 200 and they repaid 400. So that's the debt coming down by 200 net. And proceeds from the exercise of stock options. So they've actually sold some more stock options. Staff have actually been exercising their stock options and putting money into the business through that. So those are their kind of their sources. And again, don't forget that has so these two numbers here are having a diluting effect on existing shareholders. So if you're a shareholder in this company, your percentage shareholding is going down and down and down unless you're exercising, if they're doing these through rights issues. And that, I think, is really kind of, those are the key numbers that are coming, that are jumping out to me. There's nothing else in there that I've seen that really kind of jumps out. It was just that that increase in the interest payments. It just seemed crazy that and we'll go back and just look at that again just to highlight this. So if we go back to the income statement, you can see very clearly that interest expense is 14 million and it was at about 3 million, and yet the debt has not increased by 4 times, for example. So that kind of just I'm not sure. I couldn't find out why, and maybe somebody knows the answer to that. They can put it in the comments as to why that why those interest payments have gone up so much. So looking at the share price, there is no PE ratio, obviously, because there is no E. There's no earnings on this, and therefore it's a market cap of 41.42 billion. If you remember, the share price, sorry, the balance sheet is 1.5 billion. So it's basically it's all goodwill in there. There's nothing else really to sort of account for. It's valued at 38 times sales. If that's a if that's a valid a valid measure. It's got 40 billion of inherent goodwill in there. The balance sheet is pretty small. Is it a buy? Is it a sell? Moeed, I have absolutely no idea. It's not something which kind of massively appeals to me. It is burning lots of money. There is this, the expenses are going up at the same rate as the sales. That's not to say that they're going to hit gold, but as you mentioned, lots of government contracts. Maybe that's a good thing. Maybe that's a kind of a steady stream. Maybe that's over dependency on one particular customer. How much is the government really going to be spending on this when as we get to kind of end the stimulus, inflation starting to come out, maybe they're going to have to start reining back their government expenditure. So I don't know, Moeed. This is a conundrum for me.
Yeah, so there are some good stories there to in the form of the revenue increasing so much, but there are risks, right, that people should be aware of, and I think you've covered it all there. So I'd love to hear anyone else's thoughts. If there are people watching this that are very familiar with Palantir, have a bit more detail about it, please share it with us in the comment section. And as always, like, share, subscribe. If you have any companies that you would like us to analyze for you, please do leave your request in the comment section below. But until the next video, we'll look at another one. One thing to recommend, actually, we'll leave a recommendation for one video that we think you should really watch after this one, which is a video that Ted and I did on how to read financial statements, right? How to kind of analyze them, how to kind of build your confidence in doing so. We covered it slightly high level because this takes days to kind of become proficient at. But we cover the really critical things where you can quickly get an insight into whether this business has healthy or non-healthy finances at that time and moment and period. So have a look at that video. But until the next one, thank you very much, Ted. And we'll see you on the next video.
Good to see you, Moeed.